Swayam Prabha. Digital India. Educated India.
Hello, Namaste. I'm Dr. Diksha Munjal Shankar. I teach as an assistant professor at the Faculty of Law, University of Delhi. So we'll be carrying forward from the previous lecture, which dealt with the head salary, where the heads of income were concerned. Now we're moving on to our next head of income, which is income from house property. So when we are going to discuss income from house property, we are essentially going to focus between sections which are ranging between section 22 to 27. So section 22 is the charging section. Section 23 tells us what is annual value of property. Section 24 talks about deductions, and section 27, which will tell us and elaborate on what is the concept of deemed ownership. So section 22 is the charging section, and it states that the annual value of any property comprising of any building or land pertinent thereto, of which the assessee is the owner, shall be charged to tax under the head income from house property after giving deductions under section 24. So when we talk about a charging section, as I discussed in the previous lecture, it basically means that had this section not been there, had section 22 not been there at all in the Act, then any income that would have arisen out of a house property, it would not be subject to tax. So when we are discussing section 22, we are looking at 3-4 very important terms, right? So the first is annual value. So what is this concept of annual value? We will explore under section 23. Then the next highlighted term is that of owner, which we are going to look at. So up until now, we all understand that ownership means that you have, let's say, the title to a particular property, right? So if you're the title holder of a particular property, then we will say that you are an owner. But in case of taxation, we tweak that concept a little bit, and we also include the concept of deemed ownership. And lastly, we are going to look at what are the deductions which have been provided for under section 24. So what is a house property? Up until now, we all understand house property as one wherein, let's say, there are 4 walls, a roof, and we think that this is what is referred to as a house. And then that may be considered as a house property. And automatically we will think that yes, over here there are people who are perhaps residing or carrying out some sort of residential activity, as in, you have let out a particular property. So that is how we usually view house property. But when we see it from the taxation point of view, that is not important. What is important is that there is a building. Now this building could be used either for residential purposes or for commercial purposes. It does not matter, right? And therefore the concept of house property up until now, what we have understood, is very different from the way it is used in the cases of taxation. So if you look at the definition of house property, there is none provided for under the Act. So in common day-to-day usage, we refer to it as a building for human habitation. It may range in complexity and usage. So a building can be as complex as a factory or as simple as a house. It can be different in terms of its usage as commercial or residential. So it includes residential buildings, business properties, auditoriums, shops, etc. Tax is charged on the building and the land pertinent thereto as well. So what do we mean by on the building and the land pertinent thereto? So if you look at this figure over here, this is nothing but a building, right? So we understand that we have to pay tax on this building. And when we talk about this concept of the land pertinent thereto, that means any land which is actually attached to that particular building. Mind you, this is very different from a vacant piece of land. If there is a vacant piece of land, we are not looking at that as a house property. This is what we refer to as a house property. That means that there is a building and there may be a land which is attached to it, right? But if it is a vacant piece of land, that is not to be seen as house property, right? So when you look at a house property, something like this, which has got land attached to it, now this land, you could be using it for different purposes, right? Let's say a part of it, you're using it as a kitchen garden. Then a part of it, which is being used as a playground, right? So you've got a little play area. At the back, you might have a little swimming pool. So the same piece of land is being used for multiple purposes, but the important thing is that there is this building which is made on that, and that the land is pertinent to this building. So land includes approach roads, playground, courtyard, motor garage, kitchen garden, etc. And in non-residential areas, it may include car parking, playground, etc. Right? So if you, let's say for example, have the main gate over here of your entire premises. So when we say, let's say for example, you are working in the kitchen garden and you get a phone call, right? And somebody asks you, where are you? What will you say? You will not say that I'm not at home. You're still at home, right? And this is all of this is your house property. So when all of this is your house property, that is how we look at the concept of house property. You may have land that you're using for different purposes, but then it just stops there. Why? Because we consider the entire bit of land which is attached to your building as a part and parcel of house property. So you may have this as your main gate. You may want to build a little approach road, right? You may have a little car parking over here for yourself. So all of this little road, this car parking that you have built, everything gets included as a part of house property. So income that is there from subletting a property is not income from house property. It will fall under the head income from other sources. So what happens is that, let's say for example, you've got this house over here and you have got 2 floors. Let's say that this is the ground floor and this is the first floor. This part is your first floor, okay? And you have let out the first floor to a tenant T. Now tenant who you have let it out to further sublets it, right? And when the tenant further sublets it to a person A will also pay tenant some amount of money, right? And then you as a tenant, you are also going to pay some amount of money to the landlord. Now landlord over here has actually occupied the ground floor. So your landlord is Mr. X and you are paying the amount of your rental money to the owner who is X, right? So you paying your rent to X and A is paying to you rent but from subtenancy. So when you are receiving money from A, because you are not the owner, can we say that you are the owner as a tenant? You are not the owner, right? And therefore you cannot see or you cannot put this income that you're getting from subtenancy as income from house property. This is not your income from house property. Why? Because you are not the owner, okay? But when you are paying rent to Mr. X, who is the landlord, and that is the owner, then the income that is falling in the hands of X, that is to be treated as income from house property, right? So imagine it's the same house building, it is the same building that we are looking at, right? And just because you are a tenant who has sublet a part of that building out, you will not be getting that income in your hands as something that will fall under the head income from house property, but rather it will fall under the head income from other sources. And over here, the landlord or the owner who's living on the ground floor has self-occupied that particular premises on the ground floor. That person, when he is getting money from you, simply because of the fact that he is the owner, that income in his hands will be treated as income from house property. So the concept of ownership is very important to determine whether or not you can put an income under this head of income from house property. So now we look at this concept of gross annual value. So every property will have a gross annual value to itself, because only when we know the gross annual value can we find out what is your taxable income from the house property. So how do we understand gross annual value? Gross annual value has been provided for under section 23, and it is stated that from gross annual value you will subtract your municipal taxes, and what you get in your hand is your net annual value. Okay. Now when you have your net annual value, that is NAV, from that you will subtract your deductions which have been provided for under section 24. Now section 24 provides you two deductions. The first deduction is provided in clause A, which says that you will get standard deduction, which is what? 30% of your net annual value. So whatever net annual value you have been able to calculate, 30% of that you will get as standard deduction. And second is that in case there is a loan on that particular property, then that interest amount on the loan comes through as a reduction under section 24 clause B. So once you have subtracted these deductions from the net annual value, then we are able to find out what is the taxable income from this head, house property. So when we talk about net annual value, we understand that okay, fine, I will be able to find out my net annual value by subtracting my municipal taxes. Municipal taxes are easy to determine, but where am I supposed to subtract it from? From the gross annual value. And where is this concept of gross annual value? In section 23. But how do I find out what is the gross annual value? So let's look at that. So to be able to determine the gross annual value, we need to keep in mind four very important factors, right? One is going to be a municipal value, second is going to be fair rent, third is going to be a standard rent, and then you've got actual rent. So when you have these four components in front of you, you will be able to compute your gross annual value very, very easily. So let's start with the first aspect, which is actual rent. Actual rent is what? The name speaks for itself. Actual rent means the rental income that is actually falling into your hands, the rental income that you are actually receiving, right? So whatever rent you are receiving, that will be considered as your actual rent. But when you give out a property on rent, you give it out for, let's say, a whole year, okay? And when you give it for that 1 year, 2 years, 5 years, you are taking it for granted that, well, you are going to receive rent for the entire year, right? So every month the tenant is going to pay you, and at the end of 12 months you can easily say that I have received my annual rent as this amount, okay? But there might be certain circumstances wherein you have given it out on rent, but let's say after 6, 7 months, 8 months, 10 months, the tenant says that I am not going to pay you or I cannot pay you, right? So what do you do in those cases? Now you have given out your property out on rent, and this person is coming up to you and telling you that I cannot pay rent or I am not going to pay rent. So at that point of time, you have this margin of unrealized rent. And how do we deal with that when we talk about actual rent? Because you had anticipated that some amount of rent is going to come, and now you have this margin of unrealized rent. And if you're not able to actually gather your unrealized rent, then you will have to pay tax on the actual rent, even if you have not been able to sort of go ahead and show that you have some sort of unrealized rent that you're wanting or you're anticipating it to come. So if you cannot prove that you have unrealized rent and the assessing officer is not satisfied about it, then you will be taxed on your actual rent. So let's look at that. So in case of actual rent, there is 12 months of income against 12 months of tenancy. That's the basic underlying thing. But let's say you have received 10 months of income against a 12 months tenancy, right? So there is unrealized rent for 2 months over here. Now to get the benefit of unrealized rent, the assessee needs to fulfill 4 conditions under Rule 4. So what are those? One is that there is a bona fide tenancy. That means in good faith there is a tenancy that was carried out. Second is that there was action that was taken against the unrealized rent by the tenant having to vacate the premises. So simply because there is unrealized rent, you did not sit over it as the owner. You actually made the tenant step out, tenant vacate your premises, right? And the basic condition that this tenant must not be in possession of any of your properties, that is at least fulfilled. Now let's say for example you've got 4 properties. So these are your 4 house properties, right? Now let's say for example you've got unrealized rent problem in house property number 1, okay? And then when you are crying that I have not received my rent, complete rent, I have unrealized rent, what you do is you get the tenant to move out of house property number 1 and then shift that tenant to house property number 4 and show that, well, there was a tenant in house property number 1 who did not pay. Now that is not permissible, okay? So what you need to do is you need to ensure that the tenant is not occupying either house property number 1 where the whole problem arose, nor any of the house properties which are in your possession, right? So action was taken against the unrealized rent by the tenant having to vacate the premises. So the tenant should no longer be in possession of any of the properties of the assessee. So if you're owner of all of these properties, that tenant who's the problematic tenant who has not paid you your rent in entirety, that person should not be in possession of any of your properties, right? Next, the assessee has taken all legal steps against the tenant to realize the unrealized rent, right? So you have taken all the legal steps against the tenant. So you've probably gone and filed a complaint, you've probably gone and filed a suit for eviction, for not just for eviction but for gathering your unrealized rent, right? So you have taken all the legal steps but nothing has happened, right? And finally, number 4, that the assessee needs to satisfy the assessing officer that even after all efforts, the tenant has not and will not pay the rent. That I have tried my best, right? I went and I pleaded and I told that you need to pay your rent, he did not pay. I threw him out, he did not pay. I did not let him allow occupation of any of my other properties. I did not enter into any sort of tenancy agreement with him on any of the properties. Nothing happened. I have gone and filed suits against him. Nothing has happened. So now if the assessing officer is satisfied that really this person is not going to be able to get this unrealized rent in his hands, then he will give the benefit of unrealized rent to the assessee, right? So if the assessing officer is satisfied that the rent will not be realized, then in that case the benefit of unrealized rent will be given. But if you are not able to do that, then the assessee will be taxed for income of 12 months on the house property. So maybe he left the house property in 6 months, but you have not been able to satisfy the assessing officer that really you have a margin of 6 months unrealized rent for which you are seeking benefit, and you are not able to satisfy him with respect to all of these 4 conditions. And if that is not the case, then you will have to pay tax on your 12 months of income on the house property. Next concept is of municipal value. So municipal value is fairly easy to determine and it is determined on annual basis. So it really depends on the municipality where you are located, how the municipal value is calculated according to that particular municipality. Then we have standard rent. So standard rent is a concept which is not applicable everywhere. It is applicable only where Standard Rent Control Act is applicable. So what they do is they sort of put up an upper limit in terms of how much of rent can be gotten from properties which are located within those specific areas. So it provides for the maximum rent that you can get from the property, and this is also to be determined on annual basis. Then we've got the concept of fair rent. So when we talk about fair rent is to be determined by how much a similar property would fetch in the same area, and that is also to be determined on annual or per annum basis. Now let's say for example you've got house property number 3, right? You need to calculate the fair rent for house property number 3. You do not know what is the fair rent. So you will start looking at what is the rent that, let's say, house property number 1 is fetching. So you go, you speak to your neighbor and you ask how much rental are you getting for this particular property, right? So you get an estimate that, let's say, this person is getting 20,000 as rent per month. House property number 2, over here, when this was given out on rent, it was fetching 50,000. Okay, and when you looked at house property number 4, this was fetching around 55,000. Now you need to calculate for your property how much of fair rent would be there, right? You're looking at a property which is fetching 20,000 and then one which is fetching 55,000. So there's a huge gap, right? So what is it that we look at when we want to determine fair rent? We will look at what is the location, right? So there is something unique about house property number 4 compared to house property number 1. Maybe house property number 1 is not kept in a very good state, is all broken inside, it's in a very dilapidated condition, and therefore it's fetching only 20,000 rupees for the landlord, for the owner, right? And if you compare that with the rent of 55,000 that the owner is getting out of house property number 4, then there is obviously, this factor that the house has been kept well, or that the location is extremely good, right? So you will keep in mind certain factors to be able to understand why is a property getting 20,000 and why is a property getting 55,000 as rental income. Now for you to be able to determine your fair rent over here, you cannot possibly consider 20,000 for your case unless and until your property is also in an equally dilapidated condition. So if your house from the inside is all broken and tattered, then obviously you can see house property number 1 as an example, and you can say that yeah, our fair rent would be somewhere around 20,000-25,000, right? But if your house is one which is well kept, is in a similar area, everything is on similar basis, then you know for a fact that your rental income would also be somewhere ranging between 50 to 55,000. Could even go a little bit higher than 55,000, provided that there is something that's really adding on that value. So let's say for example, yours is in the most ideal location, right? So house property number 4 has a service lane all across, right? So let's say this has got a service lane, this has got a service lane. But house property number 3 has got service lane coming up, and then on this side you've got a little green area, right? And because it's got a nice green area, green patch next to it, the rental income that you could see could be slightly higher also, right? So it really depends on a lot of factors. Maybe house property number 3 is also getting a lot of sunlight, right? This house property is also getting a lot of sunlight, but beyond this service lane over here is, let's say, a main road, right? So your view is that of a main road, something that may not be conducive for the purposes of fetching better rental income, right? Similarly, house property number 2 will have the view of the main road. And over here, let's say this is now not got enough sun. Okay? So this is not a very well sunlit house. It has a lot of ventilation but not enough sun. Okay? And therefore it's getting fetching slightly less rental income. So when we are looking at fair rent, we need to determine the rental income in a very, very fair manner, right? So you could say that, well, my fair rent for house property number 3 could range between, let's say, 50,000 to 60,000 also, okay? So because we've got so much of variation, you've got actual rent, you've got standard rent, you've got municipal value, you've got all of these things. So how do we find out this gross annual value, right? So gross, and the reason why we need to find out gross annual value becomes even more important because there's just too much of variation. Should I look at standard rent? Should I look at actual rent, right? Should I look at, so let's say for example, my house property number 3 would ideally give me 60,000 rent in my hand, right? But I am giving out my house on rent to a very old couple and I don't want to charge them too much. So I am happy getting, let's say, 20,000 rent also. Okay? So now you see the kind of disparity that is there between what I am actually getting and what I could possibly get, right? And therefore, to balance out all of these things, we bring in the concept of gross annual value. So to be able to determine this gross annual value, we have a stepwise process. First is step number 1, wherein we look at municipal value or the fair rent. So whichever is higher becomes your FR1. Then we look at FR1 or SR. Whichever is lower becomes your FR2. And then we look at FR2 or AR, which is your actual rent. And in that case, we will now see if your actual rent is greater than your FR2, then your actual rent becomes your gross annual value. But if your actual rent is lesser than FR2, then because the reason for that is vacancy, then in that case, your actual rent becomes your gross annual value. Or if it is due to any other reason, then your FR2 becomes your gross annual value. So to be able to reach this figure of gross annual value, which is most important, going back on these slides over here, right? So because gross annual value is your actual start out point, you need to be clear in terms of all of these factors and must have determined your gross annual value, right? So now that you've determined your gross annual value, can you actually find out your taxable income from house property? Okay, so when we talk about house property, we say that house property that you have could either be self-occupied, that means you are there, you are occupying that, or it could be let out, so you have given it out on rent, or it could be deemed let out. That means even though it is not let out, you are not getting any rent from it, but we will presume as though you are, right? So let's say for example, you've got 5 house properties, house property number 1, 2, 3, 4, 5, okay? When you've got these 5 house properties before you, you can choose up to 2 house properties which you can claim as your self-occupied ones, right? So you can say that, okay, fine, house property number 4 and 1. For me, these are my self-occupied properties, okay? And for finding out self-occupied property, I can choose the one that will attract the least amount of tax liability. Wherever I find lower tax liability, I can choose that, okay? So let's say for example, out of these 5, I know that, okay, fine, if I pick up house property number 1 and house property number 4, then I can choose them as, they are the ones with least tax liability, I will choose them as self-occupied properties, right? So when I'm seeking exemption, I can seek exemption only up to 2 house properties. So when I am showing something as self-occupied property, that means my gross annual value of that house property is going to be 0, okay? So I have identified two properties as self-occupied. Let's say, for example, I have given out H2 on rent to tenant 1, I have given out H3 to tenant 2, and I have given out H5 as nothing, right? So my H5 is vacant, H2 and H3 are actually let out. Now when I let out these properties T1 and T2, I can again find out my gross annual value, right? And I know for a fact that this is the amount of rent that I am getting from T1 and T2. Okay, so when I know that this is my actual rent that I am getting in hand, etc., it's easy for me to find out my gross annual value. So when I look at this concept of the house being vacant, H5, this fact that it is vacant, it does not mean that its gross annual value will be 0. The gross annual value of H5 can still be calculated, and simply because it is vacant, it does not mean that it is not capable of yielding any income. Okay, so this is a very, very important thing that we need to understand from this concept of deemed let out. So I have a property, I feel that I don't want to give it out on rent to anybody, okay, and I feel it's too much of a headache. I'm already dealing with T1 and T2 and they're giving me a very hard time. So I want to save myself some trouble and I say that house property number 5 will remain vacant. But simply because it is vacant, that does not mean that its gross annual value will be 0 or that it will not be consequently subject to tax. I will still have to pay tax on it. Why? Because there is this capability of this particular property yielding income, right? So we look at this concept of notional income. Okay, so notional income is one wherein we are not getting any income. We know for a fact that there is no income coming, but we imagine as though there is income coming, right? And because we are going to imagine, we are going to keep into account certain factors, those 4 factors, and calculate our gross annual value. So we are imagining as though this particular house property H5 is going to yield me some sort of an income, and that notional income will be subject to tax. Okay, so don't think that just because you don't have any tenant over there or you are not living in that particular property, you are not going to pay tax on it. You will still have to pay tax. Okay. So when we look at house property, so you've got all these 5 house properties with you, 1, 2, 3, 4, 5, and let's say for example you've picked up house property number 4. Okay, so now we're talking about self-occupied property. So when we look at self-occupied property, we will see that the self-occupied property will always have its gross annual value as 0, right? So this is something that I had stated over here. Okay. So gross annual value will always be 0, and it's stated here as well. So for self-occupied property, gross annual value is always nil. And again, just to reiterate, exemption is allowed up to 2 house properties, right? So when is it that I can say that a house property is self-occupied, right? Or when can I get that exemption? One is, of course, I can get it up to 2 house properties, right? But let's say for example, I have 2 house properties and I am putting it to use also, then we will see how is it that we can call a particular property self-occupied or not. So let's see, this is a building, right? Let's say for example, it's got 2 floors, both of which for which I am the owner, right? Now I have this ground floor with me and I have the first floor with me. I like to live on the ground floor for 10 months, okay, because maybe it's too hot wherever I live. Okay, and I feel ground floor is a much better floor to live in, and because I'm going to face very harsh winters, I like to go up on the first floor. Why? Because I get a lot of sun and ventilation, etc., and I like to enjoy my winters on the first floor. Okay, so 2 months I am occupying the first floor. Now you will see that I have occupied that property, these 2 properties, throughout the year. Okay, so if I'm looking at the ground floor, I have occupied it, and if I have the first floor before me, again I have occupied it, even though it is for different durations. Now that I have different durations before me, that is of no importance. What is important is that I did not have any tenant come in. Okay, I did not let it out to anybody. So because there was no tenant over there, and I was occupying these two, and I have the exemption of up to 2 house properties, I am good with it. I can claim first floor and ground floor as my self-occupied property. There is no problem. Now, let's look at another situation wherein again I am self-occupying that particular property for 10 months, and again winters come and I want to go up for 2 months. But now that I know that I am going to be there only for 10 months, what I do is I get a tenant on board, and this tenant will be there for 2 months that I will be living upstairs. Okay, so when I go upstairs to enjoy the winter sun, I get the tenant to occupy the ground floor. Yeah, and then when the tenant is up there in the summer months, I come down and I live here during the summer months for 10 months. Okay. Now, when the tenant is there on the ground floor, okay, for 2 months, I am getting some income, right? And when the tenant is upstairs for 10 months, again I am getting some income, okay. But at the same time, I am also occupying the ground floor for 10 months, and I am occupying the first floor for 2 months. So what should I consider as my self-occupied property? The answer is that none of these could be considered as self-occupied property, neither the ground floor nor the first floor. Why? Reason is that if I am getting some sort of income from there, even if I earn 1 rupee from that premises, that cannot be treated as a self-occupied property. Okay. So when I am looking at ground floor, I have earned for 2 months out of it. When I am looking at the first floor, I have earned for 10 months out of it. So even though I am living in both the places, right, but simply because I have put a tenant over there and I have earned out of those house properties, I cannot claim any of them as my self-occupied properties, right? So only that property is self-occupied which has not yielded even 1 rupee as income. So only that can be considered as self-occupied. So if I have these houses, right, house property number 4 and house property number 1, that means I have not got any income out of these two properties, 0. Then only I can say that yes, these are my self-occupied properties. But if I am getting even 1 rupee income out of this, right, then I cannot claim it to be a self-occupied property. So let's say for example, this house property number 4 is the one wherein the 10 months and 2 months arrangement was there, right? So the moment I have this sort of an arrangement wherein I am getting some sort of an income, this house property number 4 can no longer be treated as my self-occupied property. And now all that I am left with is house property number 1, which is my self-occupied property, and now I have opened up doors to house property number 5, which was previously vacant, but because I have not used it for anything, it has not been given out on rent, right? I could potentially use this as my second property for the purposes of claiming it to be a self-occupied property, right? So the key factor for self-occupied property is that I should not have earned any income out of it. And over here, because I had earned income out of house property number 4, I could no longer say that, well, this is my self-occupied property. Okay. Now we are going to look at a very unique concept of deemed let out. Okay. So when we say that a property has been deemed let out, that means even though I have not, My bad. It is not deemed let out, it is supposed to be deemed ownership. So we just looked at a deemed let out, and this is supposed to be deemed ownership. So we are looking at this concept of deemed ownership under section 27. And when we look at this concept of deemed ownership, it means that even though I am not the owner of that property, I will be treated as the owner. I am not the actual owner. On paper, I am not the actual owner. So if you understand the basics of transfer of property, you will realize that the moment you are the title holder of a particular property, you will be considered as the owner, subject to other conditions, right? But broadly speaking, we know for a fact that if your name is there on the title deed, then you will be considered as the owner. But taxation tweaks that also, right? So what it says is that in case you are considered as a deemed owner, you are liable to pay tax, right? So let's look at it. The first situation that we are going to look at is that of a spouse, right? So when is it that a spouse could be considered as the deemed owner? Okay, so let's say for example, you've got Mr. X over here, and Mr. X is getting a salary of rupees 8 lakh, right, under the head income from salary, okay. Then you've got Mr. X getting an income of rupees 4 lakh as rental, okay, and that is nothing but your income from house property. So what is the overall income that the person has got? It's rupees 12 lakhs. Now this person feels that if I pay tax on 12 lakhs, then my tax liability will go up, right? So you've got certain tax slabs, 10%, 20%, 30%, whatever. Now if I am going to pay tax on 12 lakhs, let's say for example, I am in the 20% bracket, hypothetically, right? So if I am in the 20% tax slab bracket and I have to pay tax on 12 lakhs, can I do something to avoid this tax liability? Because it's going to be a hefty amount. 20% on 12 lakhs is a big amount, okay? So let me try and lower my tax liability. So what can I do? Can I get my spouse to work on my behalf and get the salary? That's not possible, right? Can I transfer this house in the name of my spouse? Yes, I can, right? So let me pick up the house, let me transfer it in the wife's name. And when I do that, the property remains in the house. Property is not going anywhere. So whether my husband is the owner or I am the owner, it makes no difference, right? The property remains as it is. He cannot go and do my job, okay? But I can still hold that property and lower his tax liability, okay? So if Mr. X feels that, okay, let me pass on this property to her and lower down my tax liability, then over here, there is this presumption that, well, you may be able to transfer the ownership to Mrs. X. So from the transfer of properties style, from the TPA style, Transfer of Property Act way, we know that Mrs. X will become the owner on paper. There is no problem, okay? But if she becomes the owner, courtesy either inadequate consideration or no consideration, okay? That means, let's say, for example, the property that has been passed into the hands of Mrs. X, that was worth 5 crore, okay? But Mr. X has sold it on paper to Mrs. X for, let's say, 50,000. We cannot say that there is no consideration involved. There is consideration involved, right? And you can sell it for 50,000. There is no problem, okay? So you sold it for 50,000, right? But can we say that this is adequate consideration? No, this is inadequate consideration. Or let's say, for example, he takes no consideration at all, 0, okay? When that is the case, either when there is no consideration or when there is inadequate consideration and the property gets transferred into the hands of the spouse, then at that point of time, it is the transferor who will be considered as the deemed owner and not the transferee. So the transferor will be considered as the deemed owner and not the transferee. So when he has passed on this particular house in the hands of Mrs. X, he thought that okay fine, house remains, tax liability shifts, and now everything is going to be the same, or rather better, because now there will be lesser tax liability. But it is understood that you have done this in order to evade tax, right? And so you as a transferor will be held out as the deemed owner, and the income that is coming into the hands of Mrs. X will get transferred back into the hands of Mr. X, and it is Mr. X who will have to pay tax on it. Okay. So let's run through the slide, which says that if Mrs. X is the owner now, the tax slab will be lower one for Mr. X, and also her income will not be taxable up to rupees 2.5 lakhs, right? So that is assuming that the threshold for the tax slabs is starting at 2.5 lakhs. Okay. So if the house property of an individual is transferred to his or her spouse either without consideration or without adequate consideration, then any income arising out of such property would be taxed in the hands of the transferor and not the transferee. If there is adequate consideration, very important, if there is adequate consideration, then it will be treated as Mrs. X's property. So let's say, for example, you've got Mr. X selling the house to Mrs. X, or not selling technically, but just transferring, right? And the property is worth 5 crore, okay? And Mrs. X pays to Mr. X 5 crore. She says no problem, okay? When she buys the property for 5 crore from him, then this property is going to be treated as her property. Whatever rental income comes from that particular property will get taxed in her hands, not go back into his hands, right? So only when there is adequate consideration, okay? Or let's say, for example, Mr. X and Mrs. X are going to separate, right? So let's say, for example, there's a divorce decree and Mr. X says that okay fine, you can keep the house, no problem, right? So when that happens, when there is a separation between Mr. X and Mrs. X, and this house is transferred for the purposes of what? For the purposes of separate residence of Mrs. X, then again this house will be treated as separate property of Mrs. X. Then it will be treated separately. Okay, that means that you are going to now tax Mrs. X on any rental income that comes through from this particular house in her hands, not in the hands of the transferor. So it is said that, however, if the transfer is made for the separate residence of the spouse, then it would be treated separately. So if the property is transferred to a minor, so up until now we saw that the first instance is one where there is a transfer between the spouses. Okay, this is your first instance. Your second one is where there are minor children involved. So you might want to buy a house, you might want to buy 10 houses, right? And because you feel that there's too much of tax liability, you start transferring those houses in the names of your children, okay? Then also, when you make that transfer in the name of your child, which is not problematic per se, but the problem is that in case there is any rental income that is coming from that particular property, or even if it is lying vacant and you need to pay tax on the notional income, then that will again go back and get taxed in the hands of the transferor, right? So it works on the same principle as a spouse. There is no difference, right? So where you had Mr. X and Mrs. X, now in case of Mrs. X, you replace Mrs. X with a minor child. right? So when you are going to transfer the house property in favor of the minor child, again that property, whatever income is coming through from that property, whether actual income or notional income, that will go and get taxed in the hands of the transferor and not the transferee, right? So it is stated that if the property is transferred to a minor, then too the amount that would be arising would be chargeable to tax in the hands of the transferor, whether there is adequate consideration or not, even if there is adequate consideration. Okay? So let's say for example, this house is what, 5 crore, and your minor child has won a reality show, okay, has got a huge bounty of, let's say, 7 crore coming into his or her hand, and says that, okay, fine, I will pay for my house, I will buy the house, okay. So even if there is a huge amount that the child holds and passes it onto the parent, hypothetically, right, then also the income will get taxed in the hands of the transferor, not the transferee. Why? Because minors cannot enter into a contract. It's as simple as that. So they cannot enter into a sale deed or anything of that sort. Anything that is contractual in nature, they cannot enter into that. Why? Because any contract with a minor is void ab initio. So you can go back and you can look at the provisions of the Indian contract. So you look at section 10, etc. Right? So if a property is transferred to a married minor daughter, then it will not be clumped. Third instance is that of an impartible estate. So impartible estate is one wherein we say that you have got some sort of a property where it is very difficult to be able to decipher that, you know, what part belongs to who, right? So if you go to any of these big forts which are there, right? So you go to Rajasthan, there are a lot of forts over there. And when you enter into the fort, you will see that there are very small shops over there, okay? So many of them all put together, and you just don't know where one shop ends and the other starts, right? And all of that put together, it's very difficult to find out who's the actual owner of those shops, specifically when they are located inside that fort, right? So in such cases, what happens is that it is the holder of that impartible estate. So what do we mean by impartible estate? We mean that there is this estate wherein we cannot clearly decipher who holds what portion, okay? Who is the owner to what extent within that estate. So impartible estate, you cannot make parts of it, okay? So the holder of the impartible estate would be considered as the deemed owner and would have to pay tax. So for example, you've got these ancient building structures, the example that I gave you, and even in case of an HUF. So HUF is taxed for that house property. Now HUF is being taxed even though individual people within that HUF might be the owners of that particular house property, right? But who's paying the tax? It is the HUF. Why? Because it is the HUF which is the holder, right? Then we have this concept of cooperative group housing societies. So if you understand cooperative group housing societies, it works as such that you've got a lot of people putting in money, right? And let's say for example, there are 10 people who want a house, right? But they all have 1 crore each. Nobody has got 10 crores or 15 crores to be able to buy a house, to buy a piece of land, construct it, etc. Everybody can spare 1 crore, but nobody can get 10 crores or 15 crores, right? So what do? These 10-15 people, they can get together, then they can buy a piece of land and they can get together, form a cooperative group housing society, and in the name of the cooperative group housing society, they can buy a piece of land. When they do that, they will all become members of that cooperative group housing society, carry out the building process, and once that building process is done, then they will go ahead and be considered as the members of the cooperative group housing society. So when you've got members of the cooperative group housing society, these members are considered as the deemed owner. So who's the owner of that land? Not these members. It is the cooperative group housing society. So if you go back in time and refer to our previous lecture wherein we had discussed the definition of person, I told you that an individual will be treated separately from, let's say, an association of persons or body of individuals or a firm or an AJP, right? So, so in case of a cooperative group housing society, it will come under the aegis of AJP, right? Now, an AJP is made up of all of these individuals, right? And when you're made up of all of these individuals are to be treated separately from that AJP. So over here, the ownership, the actual ownership in terms of, looking at it from the TPA style comes and falls into the hands of the cooperative group housing society. But it is the members who are considered as the deemed owners and they are liable to pay tax. And finally, you've got section 53A of TPA, which talks about the part performance of the contract. So if you are in possession of a particular property because you are going to go ahead and perform your part of the contract and the owner is happy to pass on that possession in your hand, possession of the property in your hand, then also you will be considered as a deemed owner, right? So there are certain conditions which need to be fulfilled. This is all basically a part of transfer of property, but you can always have a read through of it. Finally, we've got these cases. We have already discussed East India Housing when we were discussing mutual exclusivity of heads of income. And we'll quickly look at Biman Bihari Shaw Shibayat. So over here, there was this piece of land which was there, which was given out, bequeathed by way of a will. Now, there was a temple which was constructed on that piece of land and there were these priests who were there, okay. So, the will had provided that, well, this particular piece of land, on this particular piece of land, a temple could be constructed and only the priest could come and go in the temple, right. There could be nothing, no public activity of any sort that could be held out within the premises of the temple. Now, the question was that can we tax this particular premises for the purposes of taxation under the head income from house property, income from house property, right. So, can we tax it? So, over here the assessee said that, well, there is no income. Where is the income, right? Because nobody can come here, no public functions can take place, nobody's birthday, anniversary, marriage, nothing can be celebrated. We cannot even give it out for any purpose whatsoever, right? So, if people are just coming and just visiting the temple and going back, then obviously there is no income that is coming through and therefore we are not liable to pay tax. So, the court over here said that, well, that is not the case because this property, even though it is not actually let out, it does have notional income coming through to it. And as long as you have notional income coming, that means irrespective of anything, whether it is vacant or whatever, as long as you have that concept of notional income, practically no house property can be left as one wherein there is going to be zero tax liability. So, over here the court said that, well, we are going to find out the notional income, and because this particular property is capable of yielding some sort of an income, this property has to be subject to tax under the head income from house property. And then we've got last but not the least, the case of RB Jodhamal Kutiala versus CIT. So, over here, when the partition took place, there was this assessee who was the owner of Needers Hotel in Pakistan, okay, and this person, because of partition, had moved to India, and when this person moved to India, obviously he had to leave behind this Needers Hotel. You can't pick up property and take with you, sadly. So, now when this hotel was left over there and the assessee moved to India, he was being subject to tax for the purposes of paying tax on this particular hotel, Needers Hotel. So, when this question came up that whether he is liable to pay tax on this particular hotel or not, he took the contention that, well, Needers Hotel was now considered as an evacuee property, right? And not only that, over here there was a custodian who was appointed for this evacuee property by Pakistan. And this custodian over here had a vested interest in the sense that this custodian had very, very broad powers. This custodian could do anything with the property. He could break down the property, he could give it out on rent, he could sell it, he could do whatever he wanted, right? So there was no contingent interest involved, and this custodian had practically 100% control over what and how to do with this particular property in question. So over here the court said that, well, even though the assessee on paper is the owner of Nidus Hotel in Pakistan, he is not liable to pay tax. Why? Because it was declared as an evacuee property and a custodian had been appointed in Pakistan who had absolute control and vested interest in that property, and therefore the assessee over here, that is Jodha Malkotiala, he was not liable to pay tax in India. So with this, we end the concept of income from house property, and I hope that this has clarified a lot of your concepts. Thank you.